Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
G'day, how you going? Phil Tarrant, co-host, Property Investing Insights with the Right Property Group. That's R-I-G-H-T, not right, which you might expect from a journalist, W-R-I-T. Spelling's not my forte, though, and neither is property investment. That's why I get Reshmi and Victor Kumar to come into the studio once a month to chat through what's going on in the property. Victor's been doing this particularly for a long time, but I think Reshmi behind the scenes probably leading the charge inside the Kumar household as they've built quite a substantial, significant property investment portfolios, but their day jobs is as property strategists and buyers agents at the Right Property Group, a business now which should be marking its 20 years at some point.
Very close.
Soon.
Yes.
Are you going to celebrate 20 years? Is that, or are you just going to go,
Well, we had one of the goals, which was to actually climb the bridge when we reached, I think it was a certain number of properties there, and we never did it.
Yeah.
Life just got in the way, and we forgot to celebrate the small wins.
Yeah. You got to celebrate the small wins.
That's right.
Yeah. I often forget to do that, and you sort of move so quickly on to the next one that you sort of go, okay, that's done next,
Yeah.
and you know, it's
And
nice.
it becomes normal as well, right? Achieving milestones becomes normal because it just becomes part of a process. And that's the hard bit and the sad bit about successful property investing, where you tend to normalize real success. But I guess what we do with our clients is we leverage off our mistakes and say, you have to celebrate the small wins.
Yeah, and I know you don't go into too many details about your portfolio that you've built together, but I know it's quite a significant portfolio, and there would have had to have been quite a lot of successes along the way. And we've spoken about some of the non-successes, and you're very open and honest around that. And I think that's very much, to have that scar tissue would ensure that you're both better property strategists and buyers agents as a result of it. But, to your point, is it actually, what does it mean to actually be a successful property investor is one big question. And then a lot of people measure that in a number of different ways. One of them is whether or not you can actually, or whether it's possible to actually have a positive property portfolio. For many people, that's what success is, and that's what they want. And I know most investors at some point in time want to be getting a positive income from their portfolio, but I think there's a lot of misinformation or even disinformation in the market right now where a lot of people are sprouting this idea of building positive portfolios from day one. And that is possible, by the way.
It is, yes.
Depending on how big a deposit you have. But, when you scratch the surface, you see there's a lot of misinformation or information that people choose not to provide when they actually assess or break down property portfolio. So I want to get into that with you guys today because a lot of people tune into this podcast and it sort of frames or gives them a frame of reference for how they go about building their portfolio. You need to know what is actually achievable and what you can actually manage and what does it actually take to be successful. So it gives us something to talk about. But I'll start with this idea around a positive portfolio. Reshmi, what is that? What's a positive property portfolio?
A positive portfolio has to be positive in all aspects, I should say. Positive, it gives you happiness that you've got it goal going. That's not just the positive of it in cash flow terms. I look at it more in all aspects. So cash flow, yes, when it's putting money in your pocket. And life-wise, yes, it's doing things that is positive. Like you can use that money and you can do stuff that gives you happiness. So for me, we went into a positive level in our portfolio in terms of cash flow a very long time ago. And the goal at that time was that if I could replace my income and start before we started having, starting a family, that would be good, achievable, like a goal to achieve. And so that's going back, let's say, 18 years ago. So the figures weren't quite high, but for that time, it was around, the first step was, I think we got like about 37,000 to have the 37,000 coming in as income. And then I thought, well, it's just a couple of grand short of my then current income. it's okay for me to stop working. And then that's when we started the family. So that the advantage for us was, though, it was that we started very early in our lives. So we had the time. And so if we hadn't done that, then we just don't have that luxury of time to get to that sort of results. But then that being positive, at that time I stayed back and raised the family. I was comfortably living home with the children and all that. There were times when we were doing other stuff, and then it did go on the negative as well. So we kind of knew where we were going and what we were doing. So by the time we knew exactly how to manage it all and balance it. But yeah, positive portfolio brings you happiness and the positive cash flow.
So positive cash flow is good, but you want positive mindset, positive relationships, positive everything else, because debt can be one of the biggest pressures on people. So you make a good point. Does successful investors, Victor, do they normally pop in and out of positivity in their portfolios like a metronome?
Yeah, they do, right? And it's a process, right? So if you're starting off with the end in mind, the end destination can change as you gain experience as an investor, as your life changes, kids come along, businesses start, or you're changing careers, or you decide, you know what, I'm going to just hitch the caravan and travel all around Australia. I've got a client that's actually doing that right now, and property has become a great enabler for him, where he's traveling all around Australia at the moment, right? And the plan there is that he's going to eat into his positive cash flow for the next 2 years, and potentially a little bit of equity as well. But then when he comes back, gets a stable job, he'll start again and start attacking the debt all over again, right? So it's always an ebb and flow in terms of positive cash flow, until perhaps a time where you sort of think, okay, it's enough in terms of cash flow. I really need to start focusing on reducing the debt. And the good thing about it is that as interest rates come down, your cash flow increases as it goes up. It does decrease, but so do the rents go up with a bit of a lag. And it give or take, say, 10-15%. That's your fluctuation in. So consider it as overtime, right? So you get some years you get overtime, more bonuses. Other years you don't.
So I want to put something to you, Victor and Reshmi, and this is something I've been sort of considering quite a lot lately. I started building a portfolio in property about 12 years ago when prices were a lot cheaper and debt was a little bit easier to get. Is it possible today to build a high capital growth portfolio that is positively geared?
Not from the outset.
Thank you for saying that, because this is a lot of the misinformation you see at the moment, and I've got to call BS a lot as well, because you see it on your social media feeds. Younger Australians or youngish Australians, it's all the way up to 40s really, on pretty average salaries.
I like the way you're making the distinction, young up to 40, right?
Yeah. but like, on these average-ish salaries, all able to build these capital growth enabling positive cash flows. I just don't think it's possible.
Yeah.
I just don't think it's possible.
Yeah, it is if you're just purely focusing on properties, rural properties, or hard regional properties, where in the interim it is positive cash flow, but that the tide can turn against you very rapidly, right? You just get a road upgrade that bypasses the town, and all of a sudden your positive cash flow is gone, right? Because the life from the economy is being sucked out of the region. But if you were true to investing in the sense that you always looked at your exit strategy before you actually bought, you'd be buying in the high employment node areas within that 20-minute travel distance from that employment node. You've got good schools and all that. So that means actually major cities, right? And not small regional areas. And once you've got that, initially, especially at today's interest rates, they do bring in a bit of negative cash flow. Just off the top of my head, if you bought something in Sydney, you're immediately attracting between 15 to 25K a year negative cash flow before tax.
At 80% LVR?
I take the full debt into account, right? So 105% of the debt, because you're paying stamp duty as well. So this is, again, to your point, this is where people embellish a bit in
Embellish
terms of
the numbers.
figures,
Yeah,
right?
Yeah.
You've got the money from somewhere. I dare say that it is from the equity of another property. And therefore, we need to take that expense into account. So not look at each property purchase in isolation and say, yes, it's positive cash flow, it's neutral. Or if I throw in depreciation, it's actually positive. So we need to be taking that 105% exposure on the mortgage and say, okay, it's say 25K negative, right? Argument's sake. Then we need to put strategies in place to say, okay, how do you wash out the negative cash flow? So bring it back to an even plane, so into a more stable position, so that you can then add another property to it. And I dare say it's probably a 10, 15-year journey to get to that. But it needs to be methodical. We don't want to be buying for the sake of buying. And there may be years where you actually contracting or consolidating the portfolio, you're not buying anything else, but you're adding more rental income streams to bolster up the income.
Yeah, so it's like up and down till you get your feet around like exactly what is happening. And this is what I was saying in one of the other podcasts, is when we talked about and not having the finger on the pulse with the cash flow side of things. So it's very easy to, when you have other streams of income coming in, let's say for ours, it was the business and the property. So the negative cash flow, the business was supporting or things like that. So you, having gone through all of the different cycles and the different ways things happen with property investing, we know what to look out for. And that's the thing with maintaining the cash flow. That's why the strategies we use is like keeping the cash flow available so that you can grow your portfolio. So keeping an eye on the
Yeah, and that's the utility of your cash. And when I look at this, and back to my initial point, property investment in many ways, I feel as though the last sort of 5 or so years been hijacked a little bit into this sort of
because we've got phenomenal growth, right, and low interest rates.
Yeah, and it's like it's like you go to the horse races and you win your first race and you think it's really, really easy. It's not property investment. So I think there's a lot of people investing in property right now who have probably had the benefits of good timing for the last 2 years and low interest rates, who are probably struggling a little bit right now. And when you look at the lowish incomes that many property investors have, and they have multiple portfolios, that's sustainable for a period of time, but you only just need a few things to change for that to really go south, right? You know, to your point, you're able to buttress negative portfolio because you have other income. You know, a lot of the rhetoric is build a positively geared portfolio. The counter of that would be, if you're a serious property investor, you probably don't want a positively geared portfolio for a period of time at the birth of your property investment in that maybe that first decade. You know, if you're accumulating, but no one's really sort of talking about how people are covering all this negative cash flow, because I just think a lot of people are probably struggling out there.
Yeah, absolutely. And so that's one of the first questions we ask is, without impacting lifestyle, how much can you afford to chip in on a weekly basis to control the portfolio? Right? And if it's $200 a week, then as opposed to say $600 a week, the portfolios will look different, and the process would be different, but the end outcome's still the same, right? It's just the journey becomes different. So if I can use the analogy of us coming to the studio to get the free coffees over here today.
Nothing's for free, Victor.
So he says, talking to an Indian mate. We chose to pay toll, right? So we came faster. In other words, more negative cash flow. So the journey was faster, right? Although Sydney traffic, you sort of question that. But we could have also come the scenic route where there's no toll. In other words, lower negative cash flow, but it would take us longer. And there are many stops along the way because of the traffic lights, which if you look at it from an investor point of view, you're stopping when you redline your borrowing capacity or your deposits, for that matter, and then you need to stabilize. And perhaps the journey is you buy one, then you build a secondary income dwelling on that property to wash out the negative cash flow, so that it gives you the platform to get to the next one. Whereas someone that's got a much higher tolerance for negative cash flow, we could go down the path of first 5 years just go hell bent for leather and then you consolidate, then you restructure mortgages to bring the negative cash flow down.
Yeah, and it's okay to have negative cash flow. What you're talking about there is the utility of money and how that is inversely connected with utility of time.
It is.
And it's a really good analogy you've used there. I think a lot of people probably break the speed limit a lot of the way if they're going down that pathway and they find themselves coming to a crashing halt.
Yes.
And it happens a lot. They lose their license and they lose their ability to invest in property, or they get to a point where they want to upgrade their ability to move even faster, but they can't do it either, right? Because they completely redline. There's a point where, and it's a really interesting thesis, someone should do a PhD on this, that the speed of growth of how you're able to generate income, as in the money you earned through swapping your time for a job, right? That doesn't go on forever. There's normally a hard stop for most people where they're only able to earn a certain amount of money, right? It's only a fraction of people who are able to perpetually increase their income over the years. And a lot of the times people will probably tap out maybe at their 40s or 50s, right? That's the peak earning years, right? So if you accelerate really fast at the front end of it, you wear negative cash flow, you're going to get a huge upside on capital growth. But don't expect to be doing that forever. Back to the time point of view, if you want to build a positive cash flow property really quickly, you got to invest a lot of your personal time, energy and effort. It's very tactically orientated, right? Whereas if you can be a lot more forgiving on negative cash flow, which I'll put myself into that bucket, you just go, it'll be all right. I don't worry about that today, right? So you got to be all in. You absolutely be all in. But again, you probably don't want a positively geared portfolio straight away.
Yeah. Well, look, it depends on what's happening in life, right? So the portfolio needs to revolve around life and what your goals are. And for some, yes, you'd want to get to that positive cash flow a whole lot faster. A good example would be your PAYG right now.
Yeah.
And your plan is in 5 years' time, you're starting a business. And so within that 5 years, you need to at the very least, get to neutral cash flow so that when the startup of business, you haven't got the anchor dragging you down.
That's a good point.
Whereas opposed to someone that is going to be in a career corporate or career PAYG, you've got 20 years, 30 years in front of you, so you can take it slower.
Yeah, and this is horses of courses and choice, and you guys had a plan to have a positive gear portfolio for certain reasons. That's cool, and you've moved in and out of positivity, which is an expectation. Do you think when people come and talk to Right Property Group, how many of them sit there going, I want you to build me a big portfolio that's positively geared really quickly? Is that a unicorn? Does it actually exist?
People have expectations of the property, thinking, I'm looking for a positively geared property. Can you find me that?
Yeah.
It's like, okay, what do you want to do with it?
Yeah.
Why do you want that? So a lot of people still don't understand the core investing, like what it really means. They're looking at property itself.
Rather than properties.
Yeah. And the thing is, I think everybody knows that I've got to buy a property. My first question is, why?
Yeah.
Why do you want to buy a property?
That's a
Just
good
because
point.
everybody is buying, you want to buy a property?
Yeah.
Okay, but why are you buying that property? Why do you want to buy? So that I can do this and that. Well, then one property is not going to do that for you. And when do you want to get there? Whatever you're talking about, whatever your dreams and goals are. So it's like, okay, if you want to put your children into uni and all that, this is the amount of fees you're looking at in 10 years' time or something. So a property, what are you going to do? You buy today and wait for the 10 years and then sell it, and then what happens then? Then you'll fund the child's uni. But then what have you got further from there? And so are you going to continue working your whole life and you only get your income while you're working, and once you stop working, then where's any income for you? Are you going to then depend on what you get given by the government? Or so it's more like a planning, making them think, opening their eyes to see what the opportunities are, what they can do. They have the potential, but just making them realize that it's not just buying a property or a positively geared property or something like that. So there's a lot more that goes into, and my problem is that when we ask questions, we want to help you, but people actually don't want to give answers.
Yeah.
So
It's probably because
very
they don't
hard.
really know the answers themselves as well.
I reckon
Yeah.
there's so many people, property investors, walking around having no idea why they're investing in property other than they probably heard
Yep.
me chatting on the podcast
It's
going,
the
it's a
thing to
good
do.
thing. Yeah, it's a
Yeah.
thing to do. And you should definitely not be investing in property if that's the case, you know, and you need to be emotionally disconnected from property. Property is a tool for wealth creation.
Yeah.
It's all it is.
Yeah.
You know, it's like people are sitting there, I love property. You go, really? Why do you love property? I don't love property. I find property annoying personally.
True. I love the result.
I love the result,
Yeah.
right?
Yeah.
You know, I'm highly invested in the result of it, but you know, I often sit just going, I don't want to even deal with this. It's a nightmare, right? But these people with blinkers, you've got to be very careful why you're doing this and going into this idea of creating a instantly a positively geared portfolio. A property is positively geared instantly if you don't have any debt on it.
Yeah.
Yeah.
You know, and this is the point. One of the biggest beefs I have with property investment is that it's still spoken about too generally, and I'm very conscious that I talk a lot about property, right? It's so individualized. You know, we're talking about pre-tax positivity, right? It all depends how much debt you hold against it. So again, it's the strategy. You know, you can easily have a positive gear portfolio if you have less properties and you put more of your savings into it. So it's sometimes a moot point to even talk about because one person's positivity is one person's negativity.
True.
Yeah.
True. Yeah. It comes back to, well, you don't want to give money away unnecessarily, right? So therefore, if you are able to sustain the negative cash flow and hold on to a lot more properties that are all going up in value, mind you, not at the same time, they'd be in different cycles. It certainly helps doing that, right? Now, if you look at stats, most people, when they're buying an investment property, tend to sell within the first 5 years of ownership. Yeah, and the hard reason for that is purely because they haven't started with the end in mind to begin with. Then they've embellished on the figures to say, yeah, it will work out because interest rates are 2.5%. Yes, I can afford this, but they're not doing the standard average interest rates that will be across the portfolio. And when it becomes harder, or when they need to change, or the property starts impacting lifestyle, they sell down, right? So if we took a formative approach to this to say that, okay, we're heading this way, this is how much negative cash flow we can afford, this is what we've got in our fuel tank in terms of capital, and this is our age, right? Working age, right? Which is very important, right? So if you're starting age, say 20s, you can just you've got a lot of time, so it's a lot more forgiving if you got it wrong. So long as you bought within your means, you'll do okay. Yeah, one property, two property, multiple properties. But let's say you start at age 55 when the light bulb went off to say, hey, 10 years time, I'm not going to have gainful employment, or I need to slow down. The property is very different, right? So we need to then start targeting areas that have shorter cycles. Yeah. And ideally, that's the time you'd potentially get into more negative cash flow in the front end to get that big lumpy growth immediately so that it de-risks your mistiming some of the properties in terms of cycle and growth, because we can't control that, right? And then perhaps we need to give it a bit more of a helping hand in focusing more on your renovation style property. So it is a little bit riskier, but not as risky as doing major constructions or subdivisions. So you're moving the needle yourself first, and then letting the market do the movement. Whereas in the younger days, you let the market do the movement first, and then you move the needle.
Yeah, and I think that's a really good important point. You probably see it in your clients, and I started investing in 2012 with you guys, right? Property Group.
One of the most troublesome clients.
Yes, and still are. And it gets to a point where when you start investing in property, it's pretty exciting and it's new.
Yeah.
Eventually, a fair bit of malaise.
It does, right? It's another one.
It does. And that's a really entitled thing to say. But poor you, right? But, you become a lot, I'm talking about myself here, but you become a lot lazier.
Yes.
Right. And a lot of that is time and where your own life and all this sort of stuff. But I don't do anything anymore. When we started investing in Right Property Group, we did renos, we did full thing, we did so many things, right? And we accelerated growth through manufacturing. Well, look, we had market timing was really good, western suburbs of Sydney, and we did a lot to actually cultivate or manufacture equity. Like, I don't do anything like that anymore. I just go,
I know. I send some opportunities your way and say, I'm not even ready with finance yet.
Yeah. I just like, I sit there and just go, I just can't be bothered. and I wish it wasn't that way. And I know in hindsight, I go back and go, what was I doing? I do it all the time. I go, I've been reasonably active recently, but I haven't been active that much recently. And I just sit there and go, like, you got to reconnect, right? And if your portfolio's negative, you sort of sit, I just go, like, it just is what it is, right? Like, I can deal with it. I know I'm getting good capital growth, and that's how I sort of justify it. But I should be, back to the point, malaise or lazy, I should be doing more to make sure my portfolio is more positively geared.
Yeah. Look, in the beginning days, I think, Reshmi, you and I were just mistaking action for results. Right. And if we're not buying property, we felt that we were stagnating in terms of our journey.
I had this big, it's like anxiety building up. We haven't done anything for 6 months. We haven't bought any properties. It's like, and that's like being immature, let's say, in that
inexperienced. Inexperienced.
Like, we haven't done anything. We need to do something. We haven't bought any. It's like we're going to be left behind, and thinking, where the hell are we going to be left behind?
I don't think you guys will be left behind. I think you're okay.
Oh my goodness!
But it is a journey, right? Some years we buy a whole lot more properties. Other years we sell down some, right? So if they've done their job, and each property needs to have a purpose in the portfolio, and that this is a trait of a true property investor, right? Each property has a meaning in the portfolio. So as an example, with your dad, right? We sold down quite a few properties because he came in uninsured here on a tourist visa and got really ill, like fatally ill. So we sold down a few properties to pay for his really expensive bills, and Reshmi took the time to take care of him. So it is an enabler, and when you look at each property, one could be for kids, and I'm just making this up now. One could be, sold down at some point in time to pay for the kids' education, their car, their wedding.
You know what? This doesn't get spoken enough about because
no one talks about selling.
No one talks about selling, but the frame of reference you would get, and again, I've got a bit of a beat in my bonnet at the moment around this, is that I think property's been hijacked the wrong way, and it's been painted as a vehicle for creating a flashy lifestyle.
Flash cars.
Right? Yeah, you know what I mean? Like, and that's okay. People want to spend money on cars. That's sweet. Good on you. That's no worries. But what you're talking about is the real utility of creating wealth through property, and that's choice, right? And being able to go, like, no one's sitting there going, I built a property portfolio so I can send my kids, and so they don't have to have a HECS debt. No one says that.
No.
But what a great use of it, or you had the choice to be able to provide medical care for your father at a point in time you needed it, right? What a great opportunity to have the choice to do that.
Yeah, the good thing with us was early days in our life, we both had a long list of goals.
Yeah.
This is what I want my life to look like. These are the things.
Did you
how I
actually
want
do
to
that?
live.
Yeah, we did.
We did.
Yeah.
We really did right at the beginning.
Did they align? Like, they must have.
Hers was a lot longer.
So we did that,
Yeah.
and then we compared each other's, and there were quite a few things that were very common. Then I had my own interests that I wanted to pursue. He had his own.
He had
things.
his fancy cars, Victor.
He's
always loved a fancy car.
he had the aeroplanes, he had the flying stuff.
Done that yet?
I had the
I do fly.
Yeah.
Do you fly?
Yeah.
You got a pilot's license?
Yeah, I almost had a pilot's license. I could do solo in the training area.
Yeah, okay.
And I was, I think, 5 hours short of getting the full private pilot's license.
And he wouldn't do it. And I said, just finish it off. No,
I thought you'd have a commercial thing by now, be flying around in a property.
gosh.
Okay, yeah.
So we used to go on Sundays to different regional areas before kids, right?
Yeah.
So we'd fly out to the regionals, have coffee, and come back on the plane.
That's cool.
Right?
Yeah.
So I'd fly out.
You as
come
the
back.
pilot in command.
Yeah, so this is way before Facebook time, so we
Okay,
can't
yeah.
show anything to anybody.
No, you don't want to.
We've done it. We've done it all. So yeah, we used to do that stuff.
So there was alignment on the important stuff.
Yes.
Yeah.
The real our values matched and all
Yeah.
that sort of stuff, and like a lot of the goals, what he had in mind, what I had in mind. So we basically, that is the blueprint of our life. that is what
Did you have it written down? Did you keep it?
We've got it.
Yeah, really?
It's still there. We've still.
How are you guys
got it.
tracking on that? Yeah.
I think most of it's ticked off.
It's ticked off, and
Yeah.
we've, whenever we a couple of years ago, we added something else on there and all that. So yeah. But last 10 years was really hard work on our on the life side of things, with parents being sick and all that.
Yeah.
But if we did not have the portfolio, we would not have been able to to take care of the parents' side of things and everything else that happened. That was quite a hard time for us.
It's a really important message, and I don't want to dwell too much on this. And if I waste my money on stuff, I don't waste it on
expensive red
on
wine.
expensive fancy cars. But you know what? But you know, I have so how you choose to spend your money is completely up to you. And a car is a very sort of visceral and visible thing, right?
Yes.
People which replicates success, and I think that's absolutely brilliant. That's how. Yeah, but that shouldn't be the only frame of reference of success in property investment, is how you choose to waste your money once you get a bit of it, right? Like spend money on stupid stuff, right?
I did buy my car though.
Yeah,
but
that's
10
cool.
years later, I got my convertible, the one I drove.
But that's really cool, right? But it's the other stuff. It's the manufacturing of value and the utility of choice that property investment gives you.
Absolutely.
And I think that should be more of the discussion around it. And I saw only a week or so ago all of this new legislation coming in. There seems to be some agreement now on behalf of the government and the coalition around aged care, right? There's this thing going pretty much, well, people are living longer. They're changing the accords. They're using this language around self-funded retiree, which I don't particularly like. I don't like the term. That means that some people are paying their own way and some people aren't paying their own way. So I don't think they've got that term right. And I think it's going to be, inverted commas, more expensive to be a self-funded retiree. But what a great gift to have.
Yeah.
The fact that you have the choice to spend your retirement and whatever aged later part of your life looks like when aged care. Like if that alone, if your property portfolio gives you a better quality of life at the back end, I think that's absolutely brilliant, right? Yeah. Yes, enjoy your fancy cars on the way through and all that sort of stuff, but that's what people should be orientating themselves towards. So, back to whether or not it's positively geared or not positively geared, I would imagine at that point in time you want a positively geared portfolio.
Absolutely.
That's the goal.
Yeah.
At that
the
point in
goal.
time, it has to definitely.
It has to be it. So there's a tipping point where you need to say, now's the time to change. Now's the time to shift. And that doesn't have to happen over a year. That could be a 10, 15-year cycle. That's how I view it.
That's the time when we say it's time to start consolidating your debts, and it's preparation towards that.
And having cash, right? And, spend it all, but if you've got something left over, you can give it to your kids or give it to the dog's home or somewhere or other, right? Like, so that still happens.
Make the most of it yourself as much as you know.
Yeah, I reckon spend it all. Spend it all.
Well, look, we go to all these auctions and private treaty homes where it's a deceased estate, right? And for those portfolios that are not planned well, the kids just try and get to the money, right? So they're selling down the asset. So this is another side of a good investor, a educated investor will put asset protection in place once they start turning that portfolio into consolidation phase. Right? So definition of consolidation phase, getting rid of the debt. Right? Now, how do we get rid of the debt? There's only three ways. Right? Surplus PAYG income, or your business income, you put into the loans. Surplus portfolio income, so that's when you build your secondary dwellings and so forth, and you turn the loans deliberately into principal and interest, right? And the third is you sell something, right? Sell cars, bananas, in our case, properties, right? So you may sell some of your portfolio down to retire the debt, or it could be that you're going out and deliberately buying other properties because now you've got the skill set and fix the problem it brings to enhance its value and sell down in a tax-effective manner. Right?
Yep.
Now, the fourth way is, of course, you win lotto. But
I'm sitting around waiting for it. You probably played the lotto.
I think he might sell it.
Occasionally I do,
So do I.
So sometimes when you get this text saying, was it US Mega Lotto, $1 billion, it's like, I could do that.
Could do that.
He might sell a property to buy lotto tickets.
Can I have a million tickets, lottery ticket?
Yeah.
You should do that. Maybe we can do that.
One.
Maybe we can do that as an example. But you raised a really important point, Victor, and we should talk about it, and that is sort of this asset planning type of thing and asset protection.
Yes.
And it's really hard when you're starting out investing in property thinking what the end is going to look like.
You can't see that far out,
You can't see that far ahead. And you've got to understand what your drivers are. When I started investing in property, I was like, I'll buy some property. I know it's the right thing to do and I'll work it out along the way, right?
Yep.
Which I'm still doing, right? I don't have a list of what I want in life. I just know it's going to work out okay. But you don't know. So your structure is really important. And so many people start one way and they've got to change everything up because it doesn't suit what the future looks like. Now, if you think about what the end result is, and that is a positive income in assets that's protected and potentially has some sort of capability for a succession or continuity as a family. It's really hard to plan that at the front end if you're young and don't know what's going on, right? And you must see people buy properties in their personal name, become really invested in property as an asset class, and then they end up selling everything out of it and starting again in new structures, maybe trust structures, right? That's okay, and that probably works for a lot of people. But what I'm seeing at the moment, a lot of people are buying their first and second properties inside of trusts. And I sit there and I query and I question that. I think that would be the exception for most, not the norm for most.
Especially if you're PAYG.
If you're PAYG,
it's sort of, you get sold.
And it's at the point being also, it's a lot more expensive investing inside of a trust. So if you want positivity, and you've seen the portfolio that we have for Smart Property Investment, we're chatting about that, and you can tune into the Smart Property Investment show. I actually measure it, what this would look like if it wasn't in a trust and what it looks like in a trust, and the numbers are very different.
Absolutely, and even if you've bought in a personal name, right, and it comes to retirement phase, there are very strong estate planning you can do that actually can turn it on its head, right? Of course, you pay at the time. You pay for really good advice. You pay for the restructuring. But it is possible, right? So you grab the property in the easiest, most convenient and lender-friendly way in the front end. And as you go through, you're morphing to different entities. But so long as you've got the end goal, all of this becomes irrelevant, right? Because you'd get there any which way you can. Bud Spencer, remember those movies? It's getting to the goal is more important. And if you look at it purely from the stats, right, the ABS stats, 1 to 2 properties circa 2 million, right? But when you get to say 4 or 5 properties, it's about 35,000 investors. And then when you get to 20, it's in the hundreds, right? So less than 200.
What?
Yep.
Yeah.
Less than
200.
I don't know.
Less than 200 people.
People.
Yes.
Own more than
20.
Is it really that low?
It is that low.
Yeah, I'm conscious I do this. You're probably a lot more considered and reflective than I am, but you just think that that's normal.
Because we run in the circles,
and it becomes normalised though. And you look again on your social media, you would assume that that's everyone. Is that what really is that? Right?
It is very low numbers. And that's because they're not taking a structured approach. And more focused on hey, everyone's buying here, so let's buy here. And so there's a natural cap to what you can buy, right? Whereas if you structure it correctly, like a successful investor would, then really, to a degree, there's no stopping because you're buying in spurts, you're restructuring, getting yourself attracted to the bank again, and buying it again.
There's a method you're following, like this is where I'm going, and so this is what I will need to do.
And I need to. I would have a love-hate relationship with property investment personally. Again, I think the outcome's great, but I do get fatigue.
The admin is
I do get fatigued by it. And I sort of sometimes get fatigued talking about property, but particularly when, again, I feel as though when I started investing, it was a lot more considered and it was a lot more, it was a tighter cohort of people who were doing it, right? And I think that the discussions were, information was harder to obtain back then. Information has been democratized. So I think a lot of people's view towards property investment is probably different to what the reality is. And I think there's a lot of people going through life thinking that they're going to be able to achieve something which they're probably not going to be able to achieve. So I just want to put that and Right Property Group has always been considered about this, right? Like, be very, very careful what you see and what you think property investment is versus what it actually is and what the realities of it is, and realistically what you can actually achieve. You're talking to hundreds of people in Australia who have more than 20. Like, that's not normal. That's a fraction of a fraction of a fraction, right? So be careful what you think the end result is. And for most people, it's probably a couple of properties.
That's it.
And you're doing well.
Yes.
And you're doing well. And you need to have an understand the appreciation of what that's going to look like in retirement. Now, if you have 2 properties and you get that at 20, by the time you're 60 thinking about retirement, you're probably going to have a few bucks, right?
Yeah,
like,
absolutely.
put that into perspective. Those properties are going to be worth a lot of money, and that's probably going to be enough. You don't need too much.
More than that, like 20 properties or whatever. Like, we all have our goals. I don't know. We were crazy when we started buying, so we just kept buying.
Yeah.
And then whatever, and then it became a thing. Like, we can do this, we can do that, and all that. And so we just kept buying. And it's, no, do we really need that many?
Do you really need it?
Yeah,
and you sit there and just go, no, you do most of the sort of
all the stuff
admin around it and operational stuff. Like, it's cool, by the way. Like, I don't want to talk down.
Yeah.
Because I have nothing to do. Like, I was just looking after my parents, right?
Yeah.
And I'm thinking, what else do I do? We've got this portfolio. Like, okay, I might as well. So I just did up the system and I started keeping records. And because if you're staying home or, you're not doing much as work-wise or going anywhere, your time is not taken up by doing anything else, then you have to find things to do, right?
Oh, I reckon, that was probably nearly a full-time job, personally.
It was.
It would have been.
Yeah, it did become like that. Now somebody else is looking after it and I just do whatever else I need to do.
Yeah, you got oversight and connect it. And look, it's a privilege to actually be a property investor. And the way I orientate it with my sort of love-hate relationship with property, and a lot of people are going, oh, poor Phil, right? So when I sit there and I just go, why am I doing this, right? I do it every now and then. Why am I investing in property? And I sit there and I'll look at like a negative cash flow position, then I'll just get out my compounding growth calculator and I'll just plug in the numbers and I'll go, okay, it's growing at 5% per year. So this is what it's costing me to hold the opportunity for capital growth. That's the way I view property investment. And I go, oh, yeah, I could probably deal with that. That's okay.
Absolutely.
That's all right.
Yeah.
So I need to calibrate myself with the end result all the time.
That's right. Yeah. And this is where a lot of people start looking at property incorrectly, right? So a couple of things here. So Reshmi and I talked about putting our goals down on paper and our vision down on paper, right? And that was courtesy of Anthony Robbins' seminar, right? Yep. We are one of the attendees there on the weekend.
Were you sitting there waving your hands around?
Screaming high fives and hugs. That's it. Yeah. Way out of my comfort zone.
Sorry, was it worthwhile going? Like,
absolutely. We are where we are because of that seminar.
Really?
Yeah, we could say that, yeah.
So it just gave you a blueprint for what to do?
It was pretty much the beginning of our life together.
Really?
And then it just...
You disliked each other before that, and then Anthony Robbins brought you together.
I still only tolerate her.
I can imagine Victor walking through Coles.
We did.
Oh, did you actually walk over Coles?
Yeah, we did. We did the fire walking. Yeah. We did everything.
Did it hurt?
Yeah.
No. Broke the arrow and the rebar, bent the rebar with putting it on the throat and all this sort of stuff. Yeah. So we've done all of that, right? So it's all mindset, right? It is all mindset. And
that's why when people whinge around us, we just don't like it. So it's like, come on, you can do it.
Am I whinging?
No.
Have I been whinging?
We tolerate you.
Yeah, tolerate
yeah. So if you look at so we put our goals down and our vision down, right? So when people are starting, one part of the couple takes the lead on things, right? And one of the common things I get is, my wife is not into finance. She doesn't understand finance. All that. I dare say you're just simply not talking her language, right? And really, if you're both then invested in the goal and what you're trying to achieve, the journey is so much more faster, smoother, and better. Yeah,
and naturally in any partnership, whether it's a husband and wife, it's brother and sister, or whatever the version of that is. You're going to find that there needs to be balance in that partnership. Yes. Someone's going to take a lead role in certain aspects of it, and someone's going to take lead role in other aspects, and that's the basis of a great partnership, and that's okay.
Yeah.
So you shouldn't get annoyed or frustrated if the partner is not as invested or involved. Yes. I bet you they like the outcome of it.
They both need to still celebrate the outcome.
You've got to celebrate it.
Outcome has to be like, if you've gained something personally, I've gained something personally.
Yeah.
It's
someone and it's great, and you don't want two people doing the same thing. You want to sort of double your resources by having whatever that partnership looks like. So the question was at the start of this is, is it possible to build a positive portfolio? Well, yes, it is.
Yes, it is.
Definitely.
But there is
Takes
so
time.
many caveats around that.
Yeah.
There's so many. It's a completely individual thing, and this
Yes.
isn't advice by any means. By way of a disclaimer, like if you're investing in property, your story is going to be different to someone else's story. Your chapter 9 is going to look something very different to someone's chapter 1, right?
Yeah.
Just accept that, and you can't really rush things too much. Back to your speed analogy, but what does it take to be a successful investor was the key point at the top of this podcast, and I'd probably take your lead on this, Reshmi, and when I asked you what positive meant, you didn't talk about cash flow first.
No.
You talked about a positive attitude or sentiments towards it.
Yes.
So I reckon that is probably an individual outcome, but you've got to have a positive sentiment and a positive approach to property investment. I think if you have that, success has either happened or it should follow shortly.
Yeah. The one thing I would say is the resilience. That's a key one for me.
Yeah.
Yeah. And not losing focus of the goal where you're going. So there's so many hurdles will come along your way, and that if you have that positive mindset, the resilience, perseverance.
But people
these are-
bandy the term of resilience around a lot, but there is something about that, right?
Yeah.
Like,
it's a character you've built, I guess.
Yeah.
It's part of you now. So
Yeah, that's good. Now, the first Right on Track.
Yes.
How did that go?
Yeah.
Oh, it was jam-packed.
Was it?
Yeah.
Yeah, it was
I was glad that you
Did
didn't come.
you give people a bit more than a coffee and a what's those Scotch finger
Scotch
biscuit?
fingers. No, unfortunately, that was all for offer.
Oh, okay.
Because we were surprised by the numbers, so we turned off the tickets on the site, but people still turned up, right?
Some people
Banging down the door.
Yeah.
Yeah,
So it felt very empowering because we did this after October 2019,
Yeah.
right? So the first time, and so Right on Track will be back in. So at this stage, we'll bring it back in November this year.
So is that 5 years, is it?
Yeah.
19, 20,
Yep.
20.
Yep.
Yes.
Yeah.
Wow.
How did that happen?
Yep.
COVID.
With COVID and
Yeah.
then time just went by.
Time went by, yeah. So we'll be hosting the next one in November, and then we'll roll it out on a monthly basis from the new year.
Wow. So packed room.
Packed room.
Packed
Yeah.
room. Lots of questions, people, because we asked,
Well, you guys are
what's
famous
the target?
celebrities these days because of your podcasts and YouTube channels.
Oh my gosh, no.
I think I've got a couple of journalists to thank for that.
Really?
Yeah.
Yeah. No, so were people like going, oh, it's great to be back in person
Yes.
and
Yes.
like, you
Yes.
know, people talking to each other and
Yeah, and the
Yeah.
requirements are coming, requests are coming from other states as well. So we don't know about that one. But yeah.
So how is property investing different today than what it was in 2019 when you did the last one, Victor? If you're going to give me your sort of 2 or 3 observations.
Everyone's spoiled with phenomenal growth, and they expect the growth to happen with every single property they buy. And they're still, off the hangover from the 2.5%. So they're expecting properties to cost next to nix to hold.
Yep.
Whereas now normalcy is starting to return, right? So your normal cycles are starting to settle in. So the growth is not going to be as lumpy. You know? And yes, it's going to cost you to hold the properties in the good investment grade areas.
So this is the point around positive cash flow.
That's it.
Yeah. You got to expect a property to cost you money to hold it, capital growth in positive areas.
Yes.
Yep. It's well considered. And did you speak, Reshmi, at it? Did you?
No.
No.
No, I didn't.
Oh,
You
I
didn't
held
have
the
me.
floor.
Did you?
Yeah.
Did you have a PowerPoint presentation? You're sitting there going, you know.
No, I didn't.
No, well,
Yeah.
I'll get out there and
I
check
think
it out.
we did the first one ever. That's like whenever we started. That's when I spoke for the first
so
time.
Reshmi
yeah.
actually started the Right on Track
Yeah,
back I think it was 2009.
Yeah, long time ago.
Down at the
was
Catholic
in-
club in
Livo.
Livo.
Yeah.
So,
Yeah.
No, in
Well,
Campbelltown.
Oh, Campbelltown.
Campbelltown.
Yeah.
That was
And then the first actual legit Right on Track actually happened in Canterbury RSL.
Canterbury RSL
But
Club.
we were having the smaller groups in our office in
In our office,
Campbelltown.
yeah.
Just like 10, 15 people talking about property, whoever was.
And that was
you know.
since 2001.
Yeah.
So
That
we
was-
did that,
yeah.
Just while I got you, and 2 minutes, sort of connecting in with what's going on in the media, a couple of things I would say is that I was looking at auction results or property price results in Sydney on on the Saturday. I think the most expensive property sold was about $6.1 million, and the cheapest was $320,000. You can still
buy properties.
At that price point in Sydney.
Yeah. But they may be cheap for a reason.
Yeah.
Right? So you need to look at.
It was an apartment in Maryland.
Yeah.
But I'd imagine that's probably not. It was an old,
not bad
it was a blonde brick type thing, 2-story, So that still exists. But importantly, also, there's a lot of information coming out now saying that there is a whole bunch of suburbs in Sydney that are oversupplied in sort of new build areas like Austell or Oakville or Rouse Hill and stuff. Yeah. It will take a long time for that to fill in, right?
Absolutely, it will. Yeah.
So asset selection is. Location is key at the moment.
It is key, and you need to look at the supply chain. You also need to look at what's happening in the area. Sometimes what appears to be oversupply isn't, because there's such a demand for those areas for that type of property.
Okay.
So you can't just rely on data alone. You really need to look at what's actually happening on the ground there. What are the drivers in that area, and in the worst case scenario, if things go pear-shaped for you, how easily can you get out of that?
And that's the point, right? Because some of these areas, 1 in 5 properties are up for sale, I reckon. So it's a very different picture that gets painted around housing affordability, housing supply elsewhere, right? So
you really have to get inside and know what's really happening there, drill down into it.
Data in isolation is very dangerous.
It's hugely dangerous, but still a lot of people make their decisions purely off data.
Just from data, I
wouldn't do it. That's what Victor and Reshmi say. They are directors. What do you call yourselves? Just directors?
Just ordinary punters at RPG.
Just struggling property investors at RPG. Well, thanks for coming in, guys. I do enjoy catching up. And I enjoy our conversations, and we've got a good rhythm. I like it. It's working well.
Yeah. Getting there for me.
That's all right. Are you enjoying coming on the podcast?
Yeah.
Do you sit there and go,
I'm trying to think how I'm going to do. I'm conscious. I'm a woman. I'm conscious at all levels, so don't worry about that.
Oh, no. Well, what I would say, it's great to have a very successful female property investor on this network in particular, because we're undersubscribed, and I'd like to see more women coming and have a chat with me, particular on the Smart Property Investment Show. So you're flying the flag for what in many ways I think are the quiet hand of successful property investors in Australia. If you scratch the surface, there's certainly a woman there doing most of the heavy lifting, I would say. So thank you.
Oh, thank you.
Thank you. That's really good. Coming up the Chrissy, so no doubt everyone's scrambling and stuff going, wanting to do something before the end of the year. How are you guys going? You up to your eyeballs? Are you? Can people sort of get into your calendar? I know you're pretty busy.
There is a little bit of a change in process where they don't speak straight away to me, so they go and speak with Kate and Melissa. Okay. So they're very successful investors in their own right. So the two stalwart women in the organization.
Again, the quiet hand,
right?
who are really
That's
the
right.
power of property investment.
It's
so
good to have them because they look at the client from all aspects, right?
Yeah.
Because people may think about I want to invest, but then they will dig down and find out what exactly why. So that's good to have that type of consultation approach there. Victor does that too. But it's very, very helpful.
Yeah, you actually get people with good EQ to speak to them first.
Yeah. That's right. And then eventually they speak with me, we've got the capacity to scale at our organisation if the demand's there.
Okay.
But I'll pre-warn that we do take our time to find the properties.
Well, there's only so many good purchases out there, to be honest with you.
It's not like we've got stock ready. It never is. So, and the good thing is our clients understand that.
Yeah.
And they'd rather wait, they said, to find the right thing.
So back to Victor's analogy, don't expect to be on the freeway all the time. Sometimes you're going to be stuck in traffic waiting for the right time to go. And so rightpropertygroup.com.au, questions at Right Property Group. We've got to do a Q&A episode. I know you get a lot of them coming through as well. Thanks for coming in, guys. Thanks, everyone, for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.